Hello, everyone. Tim Krill back for Chapter 4 of Auditing. Let me go ahead and share the screen. Okay, so I'm going to start the presentation. Okay, so Chapter 4 of Auditing looks at audit risk. And if you remember, when we were looking at kind of the stages of an audit, you remember it was the first one was initiate or continue with the client, and then it was planning the engagement, and then audit risk. So one of the early things you're going to do is, what is the audit risk? What are the areas of the company that have the most risk of possible misstatement? And you're going to look at that, and you're going to use that as far as these are the areas we want to look at the most. So, audit risk evaluated on the financial statements on the whole and individual significant accounts. So you're going to look at the financial statements on the whole, and then you're going to look at, okay, what parts of the financial statements are the most risky for this company? And those are the areas you want to look at the most. Inherent, we've talked about all these definitions. Inherent risk, the risk that basically there are misstatements within the system. Control risk, the risk that the company's internal controls will fail to detect misstatements. Detection risk, the risk that the auditors will fail to find misstatements with their audit. And all of these kind of come down to the risk of material misstatement. So there's kind of an audit risk model, which is audit risk is equal to inherent risk times control risk times detection risk. And auditors must design procedures so that detection risk will not exceed the number found for detection, for DR, for detection risk. So basically, you use this model to determine what your detection risk is going to be, and then you design your procedures based on that. So if there were heavy inherent risk, if the company did not have good controls, there'd be high level control risk. Then basically you would have to design a very effective audit, very comprehensive and full audit to overcome that, if that makes sense. I hope that makes sense. Um, Now, there's kind of an inverse relationship between the risk of material misstatement and detection risk. The greater the risk of material misstatement, the lower the detection risk auditors would allow. So you have a high risk of material misstatement, which means that maybe the company is very risky, or they don't have good internal controls. They don't have strong internal controls. A lot of those would factor together, and you'd have a high risk of material misstatement, which means you'd have a low detection risk, which means that you would not have a lot of leeway as far as detection risk goes. And it means that you would design more tests, more thorough tests. You would be looking at more things. You would be pulling more information, more evidence. You would be using more evidence from external parties because that's at a higher level than what's generated internally. Um, you would do a much more thorough, it would take you longer. You'd be looking at more information, gathering more evidence all the way around. It would be a tougher audit than if the inverse was true. If you had maybe a low risk of material misstatement and a higher detection risk, you could do a much easier audit. You could use, you could depend more on their system of internal controls. You could use lower tests, lower value test, I guess you could say. You could gather more evidence from internal sources. You could really it would be a very different audit based on how this figures out this relationship between the risk of the risk of material misstatement and the detection risk. Now, the difference between an error and fraud is intent. So we're going to talk a little bit about fraud risk here. So fraud risk factors, the book talks some about these. Management characteristics and influence, such as if management was very driven, they set a lot of goals, very much, For example, let's kind of put it this. Here's a good example of it. Back when Enron was in their prime and going strong, doing whatever they were doing, um, Enron basically had a human resource policy that every one of their employees was scored every year, and the top 20% and the bottom 20% were automatically fired. That is such a that is such a hardcore, I guess you could say, policy towards employees that as an auditor, you would have to cringe at that and think that the possibility or risk of fraud is going to be higher due to the policy set by the company. And that using that example of Enron as an example. What if management actually has a has a lot of heavy or hard to hit goals and gives a lot of rewards for those goals and basically punishes those who don't meet those goals. If that was a management characteristics in the way they did things, then of course that would, as an auditor, you should think, there could be fraud committed by employees in order to meet these goals because they're such a big part of their salary or the like. Um, so tone at the top again is very important. Industry conditions. Is the industry in decline? Is the company lagging behind their competitors in the industry? Again, does not mean that there is fraud there. In all these cases, let me kind of clarify these the things that I talked about, like with management characteristics and industry conditions here, does not mean that there is a 100% chance there is fraud. It just means that fraud could be more likely in these situations. And you as the auditor, by understanding the company, by understanding the industry, should be able to pick out, okay, there could be a higher possibility of fraud due to this situation. Operating characteristics again, are they meeting their goals? Are they not hitting budget? Are they not hitting, Wall Street expectations? Again, do they have a lot of bonuses? Do they have a heavy bonus structure? Again, it could, everything could be fine. These things do not indicate that fraud is definitely there. It just indicate that there could be a greater possibility of fraud under these circumstances. And finally, the financial stability of the company is if the company is doing very well financially, there's probably a less chance of fraud than if they're not doing well financially. They're having trouble meeting Wall Street goals and things of the like and things of that nature. Primary reason for fraud in the financial statement is meeting earnings projections set by the company or financial analyst. Again, that is something to keep in mind. If a company is not meeting these or is barely meeting these, again, it just could be an indicator. And what you're looking at here as the auditor is could could this give us a higher possibility of fraud, that we need to look into as auditors. Fraudulent financial reporting. Intentional misstatements, including omission of amounts or disclosures in financial statements to deceive users. Um, so fraudulent financial reporting would definitely be something that you would be looking for as an auditor. Kind of a definition of that here. Misappropriation, theft of assets. Misappropriation of assets is basically theft. This could come from employees, could come from an outside supplier, could come from customers. Again, this is just something you would be looking for. If it comes from employees, most theft comes from employees. Most fraud is originated by employees, according to most statistics that you read. Some ways that this could occur: embezzlement. This would just be employees embezzling funds from the company, taking a little off the top or some kind of scheme. Larceny is just plain theft. You know, an employee decides that, they're going to order an extra laptop and going to take it home and it's theirs. Um, Defalcation, again, just theft, just another form of theft of assets. These are three terms that you might see used in terms of fraud and theft at a company. Auditors must address the risk of material misstatement due to fraud for the engagement. So this is one thing that auditors are looking at, and kind of to look at the big picture. Auditors are not necessarily doing a fraud audit. There are certain audits, certain cases when an auditor finds fraud that they might pull in a fraud expert or a specialist in fraud to look at the situation. But they're not necessarily doing a fraud-based audit, but they have to build it into their audit plan and have to look for it in areas where the risk of fraud could be higher. Now, inherent risk assessment. Inherent risk assessment helps the auditor to use stronger resources and methods to test specific accounts with greater chance of material misstatement. So again, you're looking at what are the areas of greatest risk, and then as the auditor, you're going to put more of your audit resources into those areas that have the greatest risk with the client. Oops, got to go back. Okay. Okay, I'm back to where I should be now. Aspects of account with a greater chance of misstatement or fraud. So accounts that have a greater chance of misstatement or fraud could be larger accounts with larger balances, accounts with very few, accounts with lots of transactions, um, maybe an account that would have a balance that's just the opposite of what it should be. One of the things you tend to look for as an auditor is look for expense accounts with a credit balance because that's not their normal balance, or revenue accounts with a debit balance. Again, that's not their normal balance. That's just something that you tend to look for some as an auditor. Um, so these would you would kind of look for what are the aspects of accounts with a greater chance of misstatement or fraud. Examples of general misstatements: invalid transactions recorded. This would be like a sale. You went ahead and recorded a sale, but it never happened. It never happened, and it never got taken off the books. You kind of jumped the gun a little bit. Valid transactions omitted. That would be maybe omitting expenses that should be recorded. Inaccurate. Now think about it this way. If you've got invalid transactions are recorded, that's typically going to be to generate revenue, like maybe a sale that didn't actually take place. A false sale gets recognized. Or, as in many of these cases, it could just be some kind of mistake. It could just be some kind of error. Something didn't get recorded that should have been recorded. Something got recorded that shouldn't have been recorded. Most of the time, and most of the problems you're going to find in an audit are not fraud, they're just simple mistakes. Something got missed, something got, recorded for the wrong amount. So always kind of keep that in mind. And remember that the difference between fraud and a mistake is the intent. And and a lot of things are just general mistakes. But you're going to find, you'll find them, and when you find them, you point them out, and they should be corrected by the company. But it's one of those things that fraud could be behind it, but most of the things you're going to find are just general mistakes, errors. And here are some examples: inaccurate transactions. The wrong amount was recorded for the transaction. Transactions may be recorded in the wrong amount or in the wrong account. These could be errors as well. Understand the client's environment and their industry. Again, if you understand how they do business, you understand the company, you understand their industry and kind of where that company's place is in the industry. Again, it's important as far as looking at the riskiness overall of the company. And think about it this way: some industries are just riskier than others. If you're in the oil industry, oil and gas, if you're in retail, retail can go down when there's a recession or do well when there's not a recession. It's kind of some industries are just riskier than others. And understanding that risk will help you with risk assessment. Um, related related party transactions. Related party transactions would be transactions with those that could greatly influence the company. You know, family members of board members, things of that nature. And you have to make sure as the auditor that they are disclosed. If there are related party transactions that have occurred, the company did a transaction with the brother-in-law of a board member. That would need to be disclosed. That could be considered a related party transaction. Or if they did certain transactions with some of their um, maybe a subsidiary. Again, that would be considered a related party transaction, and they would need to be disclosed. Now, as the auditor, you can kind of verify this by look at the minutes from meetings of the board of directors, because any transactions, related party or not, the major decisions of the company will be shown reflected in the notes to the board of directors meetings. And so you would want to look at those to kind of verify some of these transactions and see, are they then disclosed in the notes to the financial statements? Here's another thing kind of with risk assessment. Look at accounting estimates, which are budgets, and look at how did the company do as far as meeting those estimates. Were they able to meet those estimates or were they not able to meet those estimates? Business risk. The economy could come into play. If it's a company that could be very much affected by the economy and the economy is really sinking and going down, this could create greater risk with that company, greater risk of fraud, greater risk of, it comes to financial reporting. This would be something you would have to consider as an auditor. Analytical procedures, and we talked about this a little bit with in chapter 3, are mainly in the planning and ending evaluation of the audit. So they're mainly in planning the audit and when the quality control partner does their end of the audit evaluation of the audit. Um, Examples include looking at financial ratios from year to year, doing vertical and horizontal analysis, which would be basically looking at kind of percentage and dollar value increases from year to year, or looking at common size financial statements, which would be like, as far as the income statement, making sales as 100% and looking at everything as a percentage of sales, and looking at these from year to year and looking at changes from year to year. How did it change from last year? If there's a big change in one of these areas, that could indicate an area to look at further when doing your audit. Reasonableness test. This would use, it kind of goes along with what I was saying a moment ago, in that have the numbers increased within reason or decreased within reason. If there's too much of a jump, then that would indicate something to look at. And the book talks about basically 5 steps as part of this process. Develop an expectation, define a significant difference. What do you think would be a significant difference from year to year? Compare expectation with the recorded amount, investigate significant differences, and document the preceding steps. Again, analytical procedures are a great way to plan your audit and to look at what areas do you feel like has the most risk, and then that should be factored into the audit that you perform. Inherent risk assessment, again, document risk assessment. You want to document this whole process. Significant risk, those that may require special audit consideration. Auditors can examine more transactions, rather gather higher quality evidence, or perform more tests at year end. So kind of think about it this way. For the riskier areas, these are kind of ways that auditors can deal with the risky areas. They can examine more transactions. They can pull larger samples. They can gather higher quality evidence, such as that coming from outside external sources, do more confirmations, for example, or perform more tests at year end. again, to just improve the quality of the audit in the areas that are the riskiest within the company. Auditors must report fraud findings to management at least one level above that occurrence. So if you were to find fraud like at a medium level of the company, like mid-level company, you'd go one level above and report it. And you could also report it to the audit committee. If you find fraud with senior level management, as it kind of says here, that should be reported directly to the audit committee. And remember that fraud at any level is considered material. So the auditor will always report fraud. And this is something they talk about a little bit at the end of the chapter. And this is non-compliance with laws and regulations. As an auditor, you're looking at the financial statements. You're auditing their financial statements, and you're also auditing their system of internal controls. That's another thing as the auditor you're doing is that after Sarbanes-Oxley, you're not only auditing their financials, but you're also auditing their system of internal controls as well. Do they have effective controls in place? So that's what you're looking at as an auditor. But there could be some other things that you run across in the course of doing your audit. And that's kind of what we're discussing here in this slide. So direct effect noncompliance, direct effect on financial statements such as pension funding. So if you find an error that's not so much has to do with the financial statements, but you find that they've made an error with their pension funding that would have, or let me restate that. If you find an error that would affect the financial statements, then that would be a direct effect noncompliance. And so this is definitely something you'd report because pension funding, if they had a problem with pension funding, it would affect that not only their pension fund, but could also affect the amount of cash and other resources that they have to put into that fund. So that would have a direct effect on the financial statements. That would be something that you would report as the auditor in your findings. Now, indirect effect noncompliance issues not directly related to the financial statements, such as EPA violations. This would be something that as an auditor, you're not really held responsible for knowing because think about it, if there's some kind of a waste violation or something, you're not going to really know that as a you're just auditing the financial statements and the internal controls. You're not really going to know something like that. So auditors have a much greater responsibility to find direct effect non-compliance issues. Now, if you did happen to run across something, you could definitely bring it up and that would be good, but you're not really held responsible for that because, it's like I'm I'm a CPA. A I'm not necessarily an EPA expert. So you'd be held responsible for more what's within your field, what's within your area of expertise, which would be things that affect the financial statements. And that is all for chapter 4. Thank you and have a great day.